Let me ask you something honest. Do you know what Ripple actually is right now in 2026? Because if your answer is still the company that makes XRP, you are already a few $1 billion behind the story. I'm Allie, and on this channel we talk about building real wealth, not just watching charts, and what I'm about to walk you through is not a price prediction. It is a company transformation that most people in the crypto space have completely missed because they were too busy debating whether XRP is going to $5 or $10. Before we get into it, like the video, hit subscribe if you're new, and remember, none of this is financial advice. This is for education and entertainment only. Do your own research always. Now let's talk about what Ripple quietly became. Here's the mental model most people have of Ripple. A company that made XRP, fought the SEC for years, and has been promising bank adoption since 2017. That is the old Ripple. And honestly, that version of Ripple was frustrating to follow. Lots of announcements, lots of partnerships, and a price that never seemed to reflect any of it. But something fundamental changed, and it didn't happen overnight, and it didn't happen loudly. Ripple spent 2024 and 2025 doing something that almost no crypto company in history has ever done. It went shopping, not for hype, not for marketing stunts. It went shopping for infrastructure. Let me give you the numbers. Ripple spent approximately $2.45 billion on 3 major acquisitions in a single year. Hidden Road, a prime brokerage firm, for $1.25 billion. Gregory, a corporate treasury management platform, for $1 billion. Rayless, stablecoin payments platform, for $200 million. Total investment including earlier deals, over $3 billion. Now let me explain what each of these actually does, because this is where most coverage stops at the headline and people miss the strategy entirely. Hidden Road, now called Ripple Prime, is not some small crypto broker. It clears over $3 trillion annually for more than 300 institutional clients. $3 trillion. When Ripple bought this company, it became the first crypto company in the world to own and operate a global multi-asset prime brokerage. That means hedge funds, banks, and asset managers can now clear XRP, foreign exchange, derivatives, and fixed income all under one roof that Ripple controls. Gregory gives Ripple access to something even more interesting: the $120 trillion corporate treasury market. Think about what a corporate treasurer does. They manage billions of dollars of company money, moving it between currencies, managing liquidity, handling cross-border obligations. Gregory's platform lets them do all of that. And now, with Ripple's integration, they can manage Ripple's stablecoin right alongside their regular dollars. Fortune 500 companies can now use Ripple's infrastructure without even thinking of it as crypto. Rayla, Toronto-based platform, already processes about 10% of the $36 billion global B2B stablecoin payments market. It works with over 12 banking institutions and lets businesses transact in stablecoins without even needing a crypto wallet. Ripple bought the rails literally. When you put these three together, you stop seeing a crypto company. You start seeing a financial infrastructure conglomerate that happens to have a native digital asset called XRP sitting at the center of all of it. Now I want to talk about something specific that I think is one of the most underappreciated parts of this entire story, and that is Relust. Ripple's stablecoin launched in December 2024. Within less than a year, it crossed $1 billion in market cap. By early 2026, it's being used as collateral inside Ripple Prime's brokerage products, it's integrated into Visa-linked payment pilots, it's being used for on-chain credit card settlements through MasterCard and WebBank and Gemini, and it is being managed inside Gregory alongside corporate fiat. But here is the part that matters for XRP specifically, and I want you to follow this logic carefully. When Relust gets used for a cross-border payment, XRP is often the bridge asset and the fee mechanism underneath it. Every Relust transaction that crosses borders has the potential to generate XRP demand for liquidity, for settlement, for network fees. So as Relust grows, the demand signal for XRP doesn't go away. It grows with it. This is a fundamentally different dynamic than what XRP faced in 2021 or 2022. Back then, adoption depended entirely on banks choosing to trust and hold a volatile digital asset as a liquidity bridge. That was a hard sell. Now the sell is different. Banks use Relust, which they're already comfortable with because it's dollar-backed and regulated, and XRP powers the settlement layer underneath. The front door looks like something familiar. The engine underneath is XRP. Relust also crossed a technical milestone that no other stablecoin has achieved. It became the first stablecoin to enable cross-margining between digital assets and traditional markets. That means a hedge fund can use Relust as collateral against both a crypto position and a traditional derivatives position simultaneously. That is Wall Street infrastructure language. That is not a crypto product. That is a financial markets product that happens to live on blockchain. Now let's talk about the legal and regulatory piece, because without this, none of what I just described would matter. In August 2025, the SEC withdrew its appeal in the Ripple case. The final ruling confirmed that XBRP transactions on secondary markets, meaning exchanges, retail trading, are not securities transactions. Ripple paid a $125 million settlement, which compared to the billions they could have owed, was a fraction. On the day that news dropped, XBRP jumped 11% in a single day. But even more significant, and this barely made headlines outside of financial circles, was what happened in December 2025. Ripple received conditional approval from the Office of the Comptroller of the Currency, the OCC, for a national trust bank charter. Let me tell you why that is a massive deal. A national trust bank charter means Ripple can operate as a federally regulated fiduciary. It means they can hold assets in custody with the backing of federal banking law. It means they can offer regulated custodial services to the same institutions that need to comply with the same regulations that have kept them out of crypto for years. This is not a crypto license. This is a banking license. Ripple is not just a crypto company anymore. It is a regulated financial institution, and that changes every conversation an institutional compliance department has when someone brings up using Ripple infrastructure. Think about the institutions that are now approaching Ripple. Standard Chartered published a price target of $8 for XBRP by end of 2026. That is a 315% move from current levels. A Coinbase and Ernst & Young survey of 351 institutional investors, most managing over $1 billion in assets, found that 25% of them plan to add XBRP to their portfolios in 2026. Goldman Sachs already has roughly $154 million in documented XBRP exposure. These are not retail investors speculating. These are fiduciaries with legal obligations to their clients who are now looking at XBRP and seeing something they can legally and responsibly hold. At Ripple's Community Day event in February 2026, Brad Garlinghouse and the team unveiled their 2026 roadmap, and the direction is clear. The XBRP ledger is no longer just being built as a payments network. It is being built as a full institutional-grade DeFi operating system. What does that mean in practice? A few things that are worth understanding. First, there's the native DeFi lending protocol known as XLS66. This turns XBRP from purely a bridge asset into something that institutions can also use to earn yield. XBRP sitting in a treasury account could generate returns. That is a completely different value proposition. Instead of XBRP being something you convert and discard in milliseconds during a payment, it becomes something institutions want to hold because holding it earns yield. Second, the ledger is getting permissioned markets, privacy tools, and credentialed access, meaning regulated institutions can participate in on-chain activity while meeting their compliance obligations. This is important because the biggest barrier for banks using public blockchains is regulatory compliance. Ripple is building the compliance layer directly into the infrastructure. Third, there is interoperability via zero-knowledge proofs. This means the XBRP ledger can talk to other blockchains in a privacy-preserving way. Banks don't want their settlement activity visible to the entire world. ZK proofs solve that while keeping the security of the underlying chain. The XBRP ledger has now processed over 4 billion total transactions. And exchange-held XBRP balances hit 7-year lows in early 2026. Meaning supply is leaving exchanges and going into custody, into ETFs, into institutional holdings, into places where it doesn't come back for a quick sale. Let me walk you through the ETF situation because it tells a very specific story about how institutional capital is moving. In late 2025, spot XBRP ETFs launched in the United States. Canary Capital's fund alone saw $250 million in inflows on its launch day, the biggest crypto ETF launch of 2025. Today there are 5 spot XBRP ETFs with over $2.5 billion in combined assets under management, and here's the important detail. During the crypto market volatility of late 2025 and early 2026, while Bitcoin ETFs lost over $1 billion in outflows and Ethereum ETFs lost over $500 million, XBRP ETFs continued taking in capital, 43 consecutive days of inflows, removing approximately 1% of circulating supply from the market every single month. Bloomberg has estimated that XBRP ETF inflows could reach $5 to $7 billion through 2026. For context, when Bitcoin ETFs launched in early 2024, the flood of institutional capital that followed was one of the primary drivers behind Bitcoin's all-time high that year. The XBRP ETF launch is following a similar structural playbook, and there is something deeper here. The institutions putting money into XBRP ETFs are the same institutions that now have access to Ripple Prime for brokerage, Treasury for treasury management, and Relust for stablecoin settlement. The pieces connect. They are not buying XBRP in isolation. They are entering an ecosystem that Ripple spent $3 billion building specifically for them. Now I want to be fair with you because I think you deserve analysis, not just enthusiasm. There is a real debate happening right now about what ZERP's role actually is inside all of this infrastructure. The concern goes like this. Most payment flows treat XBRP as a bridge for only seconds. A bank converts dollars to XPRP, sends it across the ledger in 3 to 5 seconds, and the receiving bank converts it to the destination currency immediately. If that's all XPRP ever does, then volume can grow enormously without XPRP price necessarily reflecting it because no institution is holding XPRP, they're just passing through it. This is a legitimate concern, and it's why the DeFi lending protocol that yield-generating feature I mentioned matters so much. If XPRP becomes something institutions want to hold because it earns yield, the supply dynamic changes entirely. But that is still being built and rolled out. Rust also introduces a complexity. Ripple's own stablecoin can theoretically handle some settlement roles that were originally imagined for XPRP. If the rails run on Rust and XPRP is just paying tiny network fees underneath, the demand signal is weaker than bulls hope. What I'll say is this: the architecture Ripple is building is real, the institutional entry is real, the regulatory clarity is real, but the path from institutional infrastructure exists to XPRP price reflects it depends on execution, and that is something no one can guarantee. Watch the usage metrics, watch the transaction volume on the XPRP ledger. Watch Rust's market cap growth. Those are the leading indicators that matter more than any price prediction. So given everything we just covered, the $3 billion infrastructure build-out, the OCC banking charter, the ETF inflows, the DeFi roadmap, the regulatory clarity, how should you be thinking about your position? The first thing I want you to sit with is this: Ripple is no longer a startup betting everything on one idea. It is a diversified financial infrastructure company with prime brokerage, treasury management, stablecoin payments, custody, and a public ledger all integrated. The risk profile of XPRP as an investment is structurally different than it was 2 years ago. The second thing is structure. Most people who hold XPRP are holding it in a taxable account. I want you to think about what that means for a moment. Every gain you realize, whether from an ETF flowing capital in, or from institutions activating on-demand liquidity corridors, or from the DeFi lending protocol creating new demand, every dollar of that gain inside a taxable account is shared with the IRS. After years of conviction, after holding through everything the market threw at this asset, your tax structure could take a significant portion of the outcome. I hold a portion of my XPRP inside a self-directed Roth IRA through Itrust Capital. The reason is simple: if the architecture I've described today plays out the way I believe it will, I keep every dollar of that appreciation tax-free. And I want to highlight, that same institutional-grade thinking is what the banks and funds entering XPRP through Ripple Prime are applying to their positions. They are not leaving assets on retail exchanges hoping nothing goes wrong. They are building custody structures around serious holdings. You should be doing the same at your level. Itrust Capital gives you institutional-grade custody inside a tax-advantaged structure. You can also hold gold and silver in the same account alongside your XPRP to commodity class assets, one digital and one physical, both growing tax-free in one place. Business owners can also access treasury accounts for LLCs, trusts, and holding companies. The link is in the description. There's a $100 funding bonus when you open your account. Here is the question I want to leave you with today, and it's not when is XPRP going to run? The better question is, what kind of company is Ripple becoming, and does the infrastructure it's building create durable institutional-level demand for XPRP? When you ask that question and look honestly at the evidence, the $3 billion in acquisitions, the OCC charter, the Coinbase survey showing 25% of institutions planning XPRP allocation, the $2.5 billion in ETF assets, the DeFi roadmap, the Rust stablecoin ecosystem, the picture is not a speculative bet on a crypto chart. It is an investment thesis built on financial infrastructure. The people who will look back at this moment clearly are the ones who understood what was being built, not just when the price would move. If this gave you a new way to see the story, like the video, subscribe, and drop your questions in the comments. I read them. Stay wise, stay strategic. I'll see you in the next one.